something that we buy first with an intention that that asset price will go up and then we will sell. Let the prices come down and then we will buy it back later.
Okay.
More time in hand, better it is for option sellers. Option buyers, they enjoy potential unlimited profit potential. So if the theta value keeps on decreasing over here, so accordingly we can select the strike price. I generally look at this particular data, all the data of options over here.
Hello everyone and welcome back to the channel. This is Nimisha and we have Zubin with us. Zubin, in the previous video we learned about calls, puts and option buying, selling. But can you just give us a short comparison between option buying and option selling with like keeping key differences about risks, rewards and all the typical strategies that are used in it?
Okay, so major, you want to know what are the differences between any option buying or option selling,
selling.
right? So let's have a charted down. Let's say this is option buying over here, and we will put option selling over here. Okay. The first thing that the difference is in buying option. If you know what is buying a call option and buying a put option, basically buying means we are going long on anything. Okay, if we are buying, if we go long on call, it means we are bullish.
Yes.
If we are going long on put, meaning long meaning something that we buy first with an intention that that asset price will go up and then we will sell.
Yeah.
All right. So if we are buying put, it's also said that we are going long on that particular instrument. All right. So buying generally means going long on that particular asset. Be it may be long call or it may be long put. Similarly, in selling, we say that we are going short. Going short meaning what? That particular instrument price we are selling first. Let the prices come down and then we will buy it back later.
Okay. Yeah.
Okay, so that's one simple difference between put option, any option buying and selling. Second, when you buy a call or when you buy a put, you want prices to move away from current price, either up or down. In case of you're buying a call, you want prices to zoom up sharply, or if you are buying a put, you want prices to zoom down sharply.
Yes.
So you need basically volatility. Yeah, higher the volatility, the better it is for the option buyers. All right, but if the volatility is less,
yes,
all right, then probably the good thing is that you can, so lesser volatility will help the premium, okay, to come down. Okay, and the option sellers will benefit from that. So when we say that it will come down, so over here after we talk about volatility, we also have to talk something about theta decay.
Okay.
Theta decay meaning time value. Basically theta refers to time value.
Okay.
The more time in hand, better it is for option sellers. Okay, so from theta decay, it is not good for option buyers. Okay, I'll write here not good for option buyers, but theta decay favors the sellers.
Option sellers.
So that is one thing, because see, more time in hand to expiry. So the prices may not go up and down so much, and every day the time value of that particular, so premium, in the option premium there are two values: intrinsic value and the time value. So what happens is time value, it will keep on decreasing, and on the expiry time value will become zero. Okay, so if the option, if the underlying asset does not move much because of less volatility, over a period of time their premium will become zero. So that will favor the option sellers. The fourth one other difference that we can understand is that option buyers, their risk is very less. Okay, so I can say limited risk. Risk is limited up to the option premium paid. So option buyers, they pay the premium. All right. Okay, so their risk is limited up to what the premium that
they've
paid.
Yeah.
All right. And when we talk about option sellers, their risk, meaning loss potential, is unlimited. So unlimited
Loss potential.
loss potential. All right, they have limited risk, or you can say loss potential. And when we talk about their profits, these people, option buyers, they enjoy a potential unlimited profit potential. And for them, the profit potential is limited
To the
up to
premium.
premium received.
Yes.
All right. So this is about the premium. Now, when we talk about the basic stuff, like when you are buyer of option, you get right to buy or sell. So if you buy a call option, you get a right to buy the underlying asset. If you buy a put option, you get the right to buy.
Buy.
You get the right to sell that particular asset.
Right to sell and buy.
Yeah. So right to buy in terms of call option if you have bought, and if you have bought a put option, you get a right to sell.
Sell.
Correct. On the other hand, the sellers, okay, they get obligated obligated to sell or
Or
buy.
buy.
Yeah. So if they are selling a call, meaning they are obligated to sell.
Yes.
If they are selling a put, meaning they are obligated to buy the underlying asset. One more difference that I can say is that the option buyers, right? They are risk takers. They are risk takers. Why is because of one psychology that maximum potential loss that they will have is whatever amount that they have invested in buying a call or a put. Okay, so how much money? So lot size into the premium is something that they have to invest. All right. But on the other side, selling, okay, they are generally hedgers. On a portfolio, they generally sell certain calls, okay, to minimize their risk. And as I said, for option buying, they have to pay the premium only. So less investment is required to buy options. But when you want to sell options, you need to pay initial margins, which are generally 10%, roughly around 10% of the entire contract size.
Yeah.
All right. So more premium, so more margin they have to pay to execute these selling strategies. So that's why some people who have less capital, they will get discouraged to come into selling. So they generally will take risk, and they will buy options and thinking it would be like a gamble.
Yeah.
That they will feel that okay, market is supposed to go up, chalo, let me buy a call.
Correct.
So this is nothing but gamble or maybe a speculation. But on the other hand, the sellers, they generally hedge their portfolio. All right. So you also you also said about what is the key difference or what are the strategies that option buyers and option sellers use. We'll definitely look into those strategies in detail in other videos. But today, let me just give you an introduction about what are those strategies.
Okay.
All right. Option buyers, as I said, they generally speculate. All right. Speculate. So they trade something called as naked options. Naked options meaning they generally buy call without anything. Simple buy call if they feel market will go up, and they buy a put. Some simple strategy. All right. The other strategies that the sellers, they generally, what they do is they hedge.
Okay.
Then there is a strategy called as covered call. Yeah, covered call meaning what? They have a portfolio of stocks. All right. And they feel that market is bearish. Market may go sideways, or it may turn down. But the portfolio, they are investors. They don't want to sell off their portfolio.
Correct.
All right. To if they sell off their stocks from their portfolio, they will attract capital gains. So they don't want to sell, but they feel that prices will come down for a short period of time. So against their portfolio, to protect their portfolio, they sell a call.
Sell a call. Correct.
Okay, so if temporarily the prices comes down, the call option premium will decay, and they will benefit from that. And afterwards, if the prices bounces back once again, their portfolio is still there with them.
Yes.
So it's a hedging strategy. We'll talk about this strategy in detail later. All right. Then there are other traders also. What they do is, against any long position, maybe long futures. Okay, they would combine that with going long on puts as well. So again, one is a long position, and meaning they are bullish. One is a bullish position, and one is a bearish position. So again, they are hedged like this. So their risk mitigate their risk, and on the other hand, the buyers are taking on the risk. So like this, the covered call is there, for good strategy for the sellers. a good strategy for the buyers is something called as long straddle. In long straddle, what do? They buy a call and they buy a put as well.
Okay.
So if there is a lot of volatility, as we discussed earlier, they need volatility. If there's a lot of volatility and they don't know which direction the prices will go, so they buy a call and buy a put together.
Correct.
Okay, so making a strategy itself. So that's the major, difference between, option buyers and option sellers. And these are some strategies that, these people concentrate on, depending on, what they want, how much risk they want to take. If they want to take less risk, option selling is recommended. If they want to take on risk, they can go for, option buying as well, right?
Yeah.
So, and yes, and most importantly, all these data, where to look at. I generally look at this particular data, all the data of options over here. We have options section completely, where we have all the modules, of options over here. You can calculate options. Calculator is there. You have various other things over here. What is option chain? The prices of calls and puts. We talked about that, theta value.
Yeah.
Okay. So where can we check all these theta values? So in this option chain, we have this theta value. So if the theta value keeps on decreasing over here,
Yeah.
all right. So accordingly, we can select the strike price. All right. So the call, the buyers, the option buyers, what they want is they want low theta. Okay, and high volatility. So IV volatilities. They want a higher volatile, so that that particular strike will benefit to them.
Correct.
And similarly, even on the put section, we have the same data over here. Okay, we have the theta. We have the, and what are these delta, gamma, theta, vega? These are option Greeks. And for that, we'll definitely cover one video on, explaining all these concepts to you as well as, our viewers.
Yeah.
So that was about it. If you have any questions.
No, right now I don't have any question. I think that very much solved the question that I had asked. And thank you so much, Zobin. You cleared the doubt that I had about the main difference between option sellers and option buyers. Viewers, what did you learn from the video? Let us know in the comments. And before that, do like and share this video with all your traders and investors friends, and subscribe to our channel so you do not miss on any updates that we put up there. Also, as he mentioned, use our platform Strike. You have 7-day free trial period. You can see how easily it has made all the traders and investors to analyze their data effectively and follow us.